It's important to remember that multifamily workforce housing is really a commercial asset. It's still residential apartments, but when you see a headline about the housing market, it doesn't always apply to our side of the industry with multifamily syndications.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, on today's episode of the Alternative Investor Mastermind, we're going to talk about why multifamily is still the best asset class for syndications and why now is probably the best time to invest. So to give you a little background, I was a single family landlord. I got started buying single family and two family houses up in Rochester, New York. And I quickly learned that it can be very, very difficult to scale. So over the years, I've migrated into investing into larger multifamily syndications, and I firmly believe it's a much better investment opportunity for a majority of investors, especially accredited investors, especially if you've had some prior success, you have a strong income or higher net worth. It's just a far superior investment for a number of reasons. So I've got a lot of questions over the past few months from investors. I'm going to address some of them here on this episode. First and foremost is that multifamily is overheated and or oversaturated, and there's too many people chasing deals. The fact is, in 2021, it was a bit overheated in my opinion. I mean, we had record low rates, we had inflation, and a lot of money, just flooding the market overall. But the fact is, there's still some systemic issues that are positive here. There's still a significant shortage of housing, especially workforce housing. And when you factor in the high construction costs, the supply chain issues, and now moving forward, the higher interest rates, there's gonna continue to be a significant housing shortage in a majority of areas. And even in areas that may have a lot of new supply, that supply is generally Class A, higher end apartments, because it's really difficult to build affordable or workforce housing, in this market without significant government or tax incentives. There's a lot of headlines about interest rates and what it's doing to the residential housing sector, but it's important to remember that multifamily workforce housing is really a commercial asset. It's still residential apartments, but when you see a headline about the housing market, it doesn't always apply to our side of the industry with multifamily syndications. And ultimately, I think that the higher interest rates in many ways are good for multifamily. Good for rentals. It just makes it more and more difficult for a first-time home buyer to buy a property. It's the mortgage they would have to pay is more than double, and right now the affordability of rent versus own is probably it's more affordable than it's been in more. The pendulum has swung more to rentals being more affordable than it has for a long time. So that side of things is good for multifamily. Had a question about the regional banking crisis and that may cause major problems in multifamily due to lack of lending. And of all the asset classes, the good thing about multifamily is there are government agencies, Fannie, Freddie, and HUD, that all lend to multifamily. So there's always the government programs, and that's a significant amount of the lending in the multifamily space. There's also insurance companies, and there's a number of non-bank lenders that are very, very active. And those are the lenders that, the non-bank lenders that have been typically doing bridge loans over the past few years that you may have heard of. So, and while I mentioned bridge loans, that's definitely a point of concern I've had raised recently. There's been a few headlines about foreclosures, and A bridge loan is not always bad. The downside of bridge loans is that the debt was generally variable rate. And at least in deals that we're involved in, there was a interest rate cap, meaning the rate could only go up a certain amount, which was generally 3%. And those deals that were variable hit that 3% over the last year as rates jumped up quickly. The good thing, though, about bridge loans is they have a lot of flexibility. The government loans I mentioned before have prepayment penalties where if you get a great offer to sell, often the penalty is so significant that it just doesn't make sense to sell. With a bridge loan, you can sell at any time. And the other key benefit is the renovation costs can be built into the loan. So if you have $2 to $3 million set aside to renovate apartments, that could actually be built into the loan. And then when the apartments are renovated, you could actually pull that money out as a reimbursement. So it means you have to raise less money from investors. I've had some concerns about diversification into more than just multifamily, and there is nothing wrong with that. I like self-storage. I like mobile home parks. Through our diversified fund, we've actually invested in a few student housing complexes and a ground-up senior living, as well as a ground-up self-storage, and we've done a few light industrial deals as well. Many of those asset classes are great asset classes. I like them. I will continue to invest in them as well. But multifamily is still, that down the fairway. More than 50% of our fund's investments are typically in the multifamily value add space. I was recently asked, does every deal have to be heavy renovation to make sense? And certainly not. The multifamily, the value add is the bread and butter of our investments, just because it's just so compelling when you have a 5 or a 6% cap rate and you can raise rents by $300 to $500 a month. That could work out to spending $10,000 to $15,000 per unit and making $70,000 to $100,000 in increased value just by spending $10,000 in renovations. So that is super compelling. With that said, stabilized properties and appreciating areas are great. If there's a deal that has higher cash flow going in day one, because it's stable and you could still buy it at solid cash flow and it's really a turnkey deal, that's great as well. How do you avoid getting scammed? That's something that it's a very important question, especially if you're coming from the highly regulated traditional financial system where there's 1,000,001 disclosures. First things first is if there is a private placement memorandum, and it was generated by an attorney and they did register their exemption with the SEC, at least then it's a formal offering and that your operators went through the time, the energy, and the money of putting together a formal offering. The likelihood of kind of running into problems when there is a formal offering is much lower than doing some small joint venture where it's a 2-page agreement in an LLC. So the private placement is a good start, and then obviously just checking track record and really knowing your operator. Fortunately for me, I got started in this a number of years ago, so we have very few deals that we're invested with where we didn't know the operator personally for a period of time, or we have a close friend, investor, or connection that has prior experience with the operator. I also am a member of a number of mastermind groups, so I spent over 100 days last year in hotel rooms, traveling, have a top status with Marriott and Hyatt. And, I've got to spend a lot of time up close and personal with some of our key operators, generally a few times a year at mastermind groups or conventions. What about the fees? I get a lot of questions about fees, and if you're following that traditional stock market Vanguard low fee environment, this is kind of apples and oranges. So, in the syndication space, the fees are certainly going to be higher than a Vanguard fund because it's just a different business. That's just an index fund. This is more like an operating business. And that's also the reason why it's more feasible to consistently earn 15+% average annual returns or IRRs, where the stock market on average may over time average around 8%, and also have the risk of significant drawdowns during periods where there's crashes. So the fees do vary. And the other difference on a syndication deal is you're typically receiving a preferred return. And that means that other than typical, a small acquisition fee and maybe a % or 2% of asset management fee, the investors are paid first. It's generally between 6 and 8% that those investors need to be paid before the sponsor makes anything on the back end. And a good deal with a good fee structure means the sponsor earns a majority of their money when the property sells on the back end. They only receive a percentage of the profits, while the investor is being protected because they receive a preferred return, so they get paid on their money, paid quarterly, every quarter while the property's in process. And then at the very end of the deal, and only at the end, does the sponsor really get their payday. I've received some concerns about not having liquidity. And look, that's one of the things that is different about this industry. And it's why we'll tell investors, don't put your last $50,000 into one of our deals. That's why these deals are typically open to only accredited investors. So those with $1 million net worth, or that make $200,000 a year, or if married, $300,000 per year. And, ultimately, it's one of the prices you pay for being in deals that have superior returns and superior tax benefits. With that said, there are some benefits of being locked up. I don't know how many of you have panicked when the stock market crashed. How many of you sold in 2020 when the market was down and didn't buy back in? It is really difficult to time the market. So being in a syndicate, being in a deal where there is an experienced general partner, where you have a solid business plan over 2 to 7 years, and where the structure of the deal has some flexibility, but really is set up to have a professional manager work in the best interests of the investors to make the best overall return. I want to share a recent success story here, and given the timing, it's something we're really excited about. Our JCAM Fund 1 had made an investment about a year and a half ago into a property in Tallahassee, Florida. It was about 160 units, and it was a little unique because it was still a condo. However, a bulk of the units were all owned by one group, and we participated in a syndicate and bought a majority of those units, and did some renovation, raised rents, and just successfully sold the property. So we made a 1.69 equity multiple. So that means on 100,000 invested, for every 100,000 invested, we got 169,000 back. We got our original 100,000 in principal and made a $69,000 profit. That worked out to a 22% IRR. So that loosely correlates to a 22% annual return, but to do IRR properly, you just need to throw it into Excel. But what's compelling there is that sold at an environment where the interest rates are towards the highest they've been. So it does prove the concept that even though rates are higher, if you execute on the business plan, if you renovate units, if you raise rents where you're expecting to after a renovation, the projects will still be successful. So congratulations to our team and our investors on that deal. Quick personal note, I just, as I record this, I just got back from Cabo San Lucas. I went out for a real estate mastermind event. There was about 30 investors, maybe 40 there. And this was a more exclusive group. And it was an amazing few days. I just got to really get to know a number of great investors there. Talked about our current projects, our successes, our challenges, and there were a number of great guest speakers there. And I learned a lot about YouTube and Instagram and really how to streamline our marketing, our message to get it out to more people. Real estate, to some extent, is the easy part. Talking into the camera and onto this microphone, sometimes gives me more stress than any real estate deal ever has. But I am glad that for the most part, I've gotten some pretty positive comments about the podcast, and we're gonna keep doing it, and we're gonna keep answering questions and addressing topics people are interested in and concerns people have. So please don't hesitate to reach out. We're on all social media, so send us a message on LinkedIn, send us an email, reply to one of our emails if you're on the newsletter, and tell us what you're thinking about, what you want to hear about, learn about, and if there's anything we can help you out with on the investment side, we're always happy to have that conversation. And whatever platform you're listening on, please do like and comment. It helps the algorithm. So if you're on iTunes, please leave us a review. Please like and subscribe on YouTube. Same on Spotify. And that's it for this episode. Look forward to seeing you on the next one.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.